Hello and welcome to the second quarter of 2019 Quarterly Context webinar for clients of the advisory group. This presentation is designed to help clients and friends of the advisory group receive high-level perspective regarding the economy, markets, and investor behavior patterns in order to help both our personal wealth and institutional clients better achieve their goals. Try to keep these meetings to about 20 minutes, and we will circulate a video link afterward should you like to view some portion of it again or to pass it on to someone you think we can help like we've helped you. If you have any questions, please submit them to the question box, and we'll either address those as we go along or at the end of the presentation. As always, we like to begin with a reminder of focusing on what matters and that you can control, and of course we help you with that process in this context of the broader goals that are your drivers in terms of elements that are short-term versus long-term and the ideal versus acceptable. And sometimes we hear about clients and others keeping a folded up copy of this in a pocket and having discussions with others, whether it's their spouse or committee members, sort of jotting down to see how things have changed over time and then discussing that with us or doing that with us. Taking a quick peek at recent markets before we get into some of the bigger picture items. You can see what the pattern was for last quarter, a relatively mild quarter versus the fourth quarter and first quarter recently. And some of the news regarding trade tariffs and so forth that had an impact on the markets. And of course, news has the effect of causing markets to bump around in the short term. However, in the long term, you can see where that fits in the broader trend. Usually in a given quarter is not a major driver of long-term results, and especially any given news item, even if it has creates a bump in the short run. You can see here as well that the investor market volatility patterns measured by the VIX index has remained relatively calm compared to some periods closer to the global financial crisis. However, there have been a few spikes along the way more recently and a little bit of an uptick over the last couple of quarters as uncertainty has increased. This is often times referred to also as the fear index because it measures the amount of volatility in trading essentially in the market. In terms of recent results, see the U.S. stock market was up about 4%, international about the same, a little bit less, emerging markets a little weaker but positive, global real estate also positive but not especially strong. In the U.S. bond market, however, with yields coming down with the expectation of potential rate cut has a positive effect both on the stock market and the bond markets. For the year, numbers were relatively strong, 9%, a little bit weaker in foreign, but also strong in real estate, and bonds have already materially exceeded their full expected rate of return for the year, which is closer to 3 to 4%. In terms of the mid-year, it was the best first half for the S&P, for example, since 1997, which this last two quarters being up 17%. You can see here for despite this relatively strong equity markets, the bond market is continuing to reflect concerns about the economy and the sustainability of that market. As you can see, as the most recent yield curve line here is what's called an inverted curve, where there are medium duration bonds and a little bit farther out that are lower than the shortest rates. That typically precedes a weakening in the economy, sometimes precedes a recession. The question is when that might happen. Sometimes it's 6 months later, sometimes it's 4 years later. So it's not a great predictor of when, but it's oftentimes a reasonable predictor of an eventual decline. Of course, markets are cyclical anyway, so it's telling what we already know, which is that markets don't stay strong forever. Other elements to note, some of the strength of the quarter, even though they turn out to be reasonably moderate returns, there was a surge mid-quarter after the market had a several-day dip due to Mexico tariff threats, and then with some China trade tariff thawing and the rate cut talk, that led to some boost there. The 10-year Treasury fell to a multi-year low of 2%, which was down from 2.4% not too long ago. And you can see a pattern of what the rates have been here in recent years, remaining relatively low. The economic factors that we keep an eye on and that are sometimes telling is that gross domestic product was reasonably solid at 3.1%, but there are expectations that that will cool off. This does represent now a 120-month economic expansion, which is the longest in history, at least in recorded history. And the Fed has stated that their new objective is to sustain the expansion. That has implications because if they overcut with rates, that can overstimulate and could lead to a steeper pullback down the road if that's too excessive. Rates, however, did stay the same for now, but the market is expecting a cut at some point in the next several weeks, really, or month, with the possibility of 3 additional cuts later in the year. Inflation remained low at 1.8%, and the PCE, which is the actual measure that the Fed uses to measure their decisions, it fell to 1.6%, which is below the Fed's 2% target. Unemployment was up just a hair, a tenth from the 5-year recent low of 3.6, but still above, ticking up a little bit, which is causing a little bit of concern, although not a major shift at this stage, and represents now 105 consecutive months of unemployment improvement or positive gains, essentially, over time, which is the longest on record. Another element to note regarding factors that can affect the labor force, the U.S. birth rate dropped 2% last year to a 30-plus year low of 3.8 million births, which continues a 4-year drop, or becomes the 4th year of drops, and is a fertility slump that could reshape the U.S. workforce in the future. This has interesting implications regarding immigration policy as well. Wage growth, a little bit sluggish at 3.1%, still below the 50-year average of 4%. And some studies suggest that some of what's holding that number up, even though it's sluggish, is more wage gains at the upper wage end, whereas at the lower and middle end, it's lower than that 3% aggregate number. This may be a factor to keep an eye on in terms of something that relates to consumer confidence and spending, which is 70% of the economy, because if wages, even though they may be improving in some areas, if that doesn't lead to spending, or if there's nervousness about spending, consumer confidence can fall off, and that can affect both the economy and markets. Housing prices continue to uptick a little bit. Oil was flat if you just look at the quarter-over-quarter numbers, but this end of quarter number represents a 20% drop below the April peak due to concerns about global growth slowing and to the supply glut that is being experienced. Natural gas, by the way, as part of the broader energy picture, fell 16% in terms of price for the quarter. Currency, the US dollar fell back a little bit. In terms of international environment, German rates remain negative versus the US interest rates, which are about 2%. And Europe's GDP and Japan are lower and still in stimulative stage. And they have signaled, central banks there have signaled that they're willing to and ready to stimulate further if necessary. In terms of the bigger geopolitical uncertainty wildcards, Iran has really been in the news a lot and is creating a lot of uncertainty. Trade wars and related nationalism in general tends to dampen economies. Brexit, with the rise of Boris just a few days ago, and whether or not that can be completed or will be a hard Brexit in October, and the speed of or magnitude of China's slowdown are all factors that are looming big in the minds of some investors. In terms of some of the bigger picture perspective for the economy, you can see unemployment is hovering around those lows here after a period of coming down. In other words, job growth. Wage growth has been picking up, but is starting to hover at a certain level now. Inflation, it's roughly hovering around the same level. The consumer sentiment has been picking up, but starting to hover around a level, at least in the short term here. You can see the price of oil has really been volatile in the last decade, picking up for a while and then cooling off more recently. And projected earnings, the gray here is actual earnings in the U.S. S&P 500 companies, and the green is the projected. You can see there's a little bit of a cooling in projected earnings here, and it'll be interesting to see what happens with big tech companies like Google, Facebook, and others, given the regulatory scrutiny that's beginning in Washington. In terms of business cycles, showed a similar but different chart last quarter. There are typical patterns. Nothing is this smooth or this specific, but there are general patterns about what types of stocks and holdings sometimes do better in certain environments. And some would say that we're in the late stage of a cycle now. This doesn't mean that we are specifically trying to reposition portfolios or encourage the underlying managers to reposition portfolios. However, some will be doing that based on their own research, consistent with their styles and within those parameters, at least in terms of, in some cases, underweighting or overweighting. So just notable as a reminder that markets are cyclical. After every peak, there's a cooling, and after every cooling, there's a new peak. So stating the obvious, but it's a good reminder when this market has been strong for quite a while. Valuations, if we look at the price-earnings ratio as a measure of how high prices are relative to history, a 25-year look back, they look relatively reasonably valued, not too far off. If we look at a 10-year average comparison, for example, however, there are certain sectors that look more richly valued, like the S&P, the Russell 1000 growth, which is also the S&P is large companies. Russell growth has more exposure to growth names and the tech names such as Google, Amazon, and others that have had really strong price increases over the last number of years. So you can see valuations are relatively rich here. Anyway, you can see across the different markets that shorter term valuations suggest a little bit more lofty numbers, and that sometimes can precede periods of higher volatility. In terms of where we stand now relative to the global financial crisis crunch and recovery in the blue line here, we can see this was the fourth quarter of the drop. the first quarter is especially strong, and the second quarter has been a mixed bag with being positive. It's always interesting to see this compared to the dot-com in green, the oil and financial crisis of the 70s in red, and the Great Depression in gray. However, this top chart is after inflation, which is a more meaningful way to look at the numbers, whereas the bottom chart here is before inflation, and you can see there was much stronger inflation in the 70s, and so the global financial crisis numbers actually look fairly similar, but the recovery has functionally been a lot stronger after the global financial crisis when you consider that inflation remains low, so the consumable gains are higher, in other words. And just as a reminder, I mentioned this last quarter, but last quarter was the 10-year birthday of the bottom of the market here. So it's really been a 10-year run with some bumps along the way, but one of the longest bull markets in history. In terms of behavioral finance, taking a peek at mutual fund industry cash flows is always interesting and sometimes a little concerning for the average investor. You can see way back when people were pulling money out after the dot-com boom, pulling money out of cash and bonds and pumping it into stocks, so much so that it overinflated the market and then led to or contributed to some of the declines later, and more people then pumping money, pulling out of cash just before or just after the global financial crisis. Some putting money in, really pumping. One of the biggest numbers here is pumping money in just before the global financial crisis when overexcitement about stocks occurred. These two numbers here in particular, followed by after the market dipped, some did begin to reinvest, but a number of people did miss out on some of the initial recovery period. And this pattern tends to recur over time where people are chasing returns, essentially. Most recently, you can see some concern about the volatility that happened in the fourth quarter. People pulled out and added more money, put money into bonds and stocks, only to miss some of the more recent rise. Not that rise is or will be infinite, but in general, these types of cash flows in and out tend to lead to worse results than a disciplined approach to investing. Speaking of market declines, this slide is a powerful illustration of why it makes sense not to get overexcited about stocks, for example, and be overexposed. The last 10 years have been relatively easy. It's caused some investors to get overexcited and overconfident about stocks. But when there is a pullback, what this chart shows is that when you have a certain level of loss, the required gain just to break even with the loss is considerably larger than the percentage number of the loss. So for example, if there's a 20% drop, it takes a 25% return to get back to even. If there's a 40% drop, 67% is required. If the market drops 70%, it takes 233% to recover. The global financial crisis was somewhere in here. And so some of these great numbers that we see here in the last 10 years, the first part of those 10 years was really just about getting back to even. And then from there, it's continued, especially because of cheap money in terms of low interest rates. However, that also can increase some of the risk in the market if that money is too easily accessed by companies and so forth, and individuals. In terms of additional things to think about that may be helpful to you, we'd encourage you to take a look at our blog. We've been contributing and writing about topics that impact business owners and leaders, that whether it's the personal wealth side of things, and also as for those that are fiduciaries. Some of the recent topics here at the bottom you may find interesting and helpful, so please take a peek and let us know what you think, and let us know if there are other topics that you would like to read more about or that you'd like us to write about. In terms of the quality status for the quarter, the last year, especially given some of the nervousness about markets, and the fourth quarter was the first time in a while where higher quality stocks were outperformed. So these numbers show if it's green, and the number then means that higher quality, generally lower volatility stocks outperformed more speculative, lower quality stocks by the percentage numbers shown here. Same for the quarter. The exception was that large cap growth was essentially flat, where more speculative names, lower quality names, did slightly better. This bottom chart shows high and low quality stocks ranked for each year. And so you can see for a number of years, the lower quality stocks, B minus, C and D and so forth, had really dominated. That's a lower quality favored period. Whereas more recently, higher quality is beginning to have a little more of its day. What's interesting here is that the highest quality stocks in the second quarter did worse than the almost highest level quality stocks. So any given quarter and any given combination of stocks can be a little bit of a mix-up, but the general trends are interesting. You can see where higher quality stocks in orange here have generally been uptrending. Those types of stocks are oftentimes helpful and create a little extra cushion, a little bit less downside when markets get bumpy. For the asset class corner this quarter, two different images of the same thing. This chart on the left shows the U.S. market, large cap growth, large cap value, small cap growth, small cap value, with the proportional size of the different stocks in those markets. So you can see in terms of overall market capitalization, large cap in general dominates the market. But the actual number of names or stocks, if you look on the right-hand chart, small cap dominates the market in terms of the number of stocks. So a different perspective, or two different perspectives for looking at the markets in terms of size of company versus the number of companies. For 401k fiduciaries, a few notes about recent studies that may be of value as you're thinking about next steps and the evolution of your retirement plans and how you've structured and how you're providing support and guidance to plan participants. There was a recent Callan study and a recent Vanguard study. Some of the highlights are that financial wellness is really the biggest focus for communication. A lot of plan sponsors are thinking beyond just investments and trying to help people actually get where they're going, making good decisions about savings rates, in other words, beyond just the investment choices. Most companies that are using a QDIA or Qualified Default Investment Alternative, 90% plus are using target date funds in that role, and 20% are using custom target date funds. The advisory group helps clients with both of those types of scenarios, by the way. And automatic enrollment numbers have been going up, so more and more companies are automatically establishing a savings rate for people when they join the company, or in some cases re-enrolling, sort of restarting the plan at one level, and with savings rates, because oftentimes people really prefer that and stick with it, whereas if the entire savings element is left up to their own, a lot of people simply don't save anything at all, and that can lead to long-term retirement readiness, morale, and other problems. The default, how much people companies are actually putting in or determining, the average has been going up, particularly in larger plans in the Callan study, to almost 5% in terms of that initial savings rate. The initial average is about 4.6. Smaller plans, which is more represented by the Vanguard study, is about 1%, with a reasonably sized chunk in the 2% range as well. The number of plans offering automatic escalation of savings, so gradually and automatically increasing the percentage of their pay that goes into the plan, has been growing from under 50% in 2014 now to 70% more recently. And those that, which by the way, all of these factors here we think are great news because there is a big savings retirement problem in the U.S. and you can take a peek at our blog and see the Super Saver blog entry that talks about some of those statistics and how important it is to help people get to the right place. And as fiduciaries, you really have a powerful opportunity to change lives. And that's one of the things that gets the advisory group excited about being involved with those efforts as well. An increasing number of plans are offering Roth accounts that would be in addition to the traditional account type, and that we think is generally a good idea, is a little bit more complicated for companies with demographics that are a little bit on the lower education end. However, still can be helpful. A few other statistics here that are specific to the Vanguard study. Feel free to check in with us to go deeper on this at any time if you are helping as a 401k fiduciary. The Callan study also provided an interesting chart about where 401k fiduciaries are most focused. And the couple of areas that continue to hover towards the top are focusing on increasing the participation rate and the contribution rate. So that we see as very positive because you can't solve an investment, a savings problem with investments. You can have a great investment structure, but if people aren't saving enough, it just doesn't matter. The ideal is to have a strong investment program with strong participation and contributions. In terms of the rules and regulations, not a lot, anything really in the personal wealth corner, although the general element does relate somewhat to personal wealth as well. The SEC updated a regulation that clarifies and makes more stringent the conduct of brokerage firms. We view that as a positive thing since that's historically been quite loose and not always in the best interest of the consumer, unlike independent fee-only fiduciary investment advisors like the advisory group that agree in writing and by culture only to act in the client's best interest. There were a number of elements related to retirement plans in general, given that in Washington, the House passed the Secure Act for retirement forms. You can see a few elements here that we can go into detail with you that have an impact on the retirement plan landscape potentially, but it hasn't been passed yet, still needs to get through the Senate. Also, there was a bit of an unusual executive order out of Washington where the president asked the Department of Labor to review retirement plan energy trends, concerned that funds and investments that are focused on sustainability may be damaging the energy sector. The IRS also expanded plan sponsor self-corrections for certain loan failures and document amendment failures, plan documents, that is, and an interesting case taking shape, the Vanderbilt 403B, that raised questions about how participant data can or should not be used for marketing from the providers of those plan services. In terms of WealthStep, for those of you that are aware, this is our online division that we've been developing to provide aim, save, and invest advice to 401k plan participants and certain qualified individuals, sometimes family members of clients or others that are up-and-comers that want to make sure that they have a place to start that doesn't require full planning advice like our personal wealth division. This is an online tool that is approaching completion. We're shooting for the end of 2019 and had great feedback from our beta testing and demos. If you are a plan sponsor and are not or involved with a plan sponsor and are not working with us on the 401k side, let us know. I'd be happy to give you a demo about this. I think people are finding it interesting as a tool to help people achieve their goals as employees, and that's improving morale and productivity in some cases as well. The blog is also live there, so plan participants can begin to get some helpful reading and investor behavior guidance when they feel nervous. So we thank you for your time. As a reminder, the 5 requirements of success that we help clients with. If any of these 5 are missing, outcomes tend not to be optimized. And we're very appreciative of working with you. We hope you feel well supported. We would always be interested in learning how we could do better, so please reach out to us with any suggestions or questions or comments. And as always, if you know other individuals or institutions that we can help like we've helped you, that's the primary way the advisory group grows, and that allows us to focus on you as our clients, and while having a level of growth that helps us create long-term sustainability and strong outcomes for clients. Again, thank you very much. Look forward to talking with you soon.